Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. First, I just want to say thank you to everybody who showed that they were a subscriber and wanted to be in the room for our special Calgary Stampede Edition show. A reminder, that one airs on July 10th. We're going to the Stampede next week to interview Adam Waterous, so make sure you don't miss that episode. On today's episode, we've got Sadiq Adatia on the show. He's the Chief Investment Officer at BMO Global Asset Management. He oversees over $200 billion in assets, and he has direct influence over $75 billion in assets, which means he can't just change his mind from one week to the next, or he's got to be pretty thoughtful about it. And he has made some big changes in the portfolio. Let's find out what they are and why he thinks a change is afoot for the back half of the year. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. Ready to take your trading to the next level? For those interested in the dynamic world of options, BMO InvestorLine provides a robust self-directed platform. Get access to sophisticated tools that can help you identify potential opportunities, analyze risk, and implement your option strategies. From intuitive strategy selection tools to detailed market data, BMO InvestorLine equips you with the necessary resources to navigate the complexities of options trading. Start now at bmo.com/investorline. Sadiq Adatia, thank you so much for joining me on the podcast.
Thank you for having me.
So you're the Chief Investment Officer at BMO Global Asset Management and like over $200 billion in assets. And you have direct influence, over all of it, but really $75 billion of that. Is that right?
Yeah, well, $75 billion of it is our multi-asset solution. So that's where our house view really dictates how the portfolios are positioned. But yeah, I have oversight over, all of the assets that we have at BMO Global Asset Management. And most of that is really tied to, a lot of the active management strategies, our ETFs or our index-based stuff, as well as our directional stuff in terms of quant strategies or our nonlinear strategies. And then there's also a bit of on the alternative side, where when you think about a portfolio, you want to have a really well-diversified portfolio.
So with so much money tied to what you say and what your investment team says, you have to think really hard about the moves that you're going to make. And I assume you're also not switching them from week to week, right? That's a lot of money to move around.
Yeah, that's exactly right. We have a really structured approach. So every month, we actually go through a rigorous process where we highlight our views on our 5-lens strategy, which really dictates our house view. And that is looking at 3 to 6 months in advance. So really it's trying to take into consideration what is currently going on in the markets, where the valuations are at, kind of doing a comparison between different asset classes and of course currencies to get to a more unified long-term view.
And you recently changed a bunch of your views. So I'm really excited to talk to you about that because you're going back to overweight equities, particularly US equities. You're going neutral on gold, which has been a great call for the last couple of years. And now it sounds like you're saying pump the brakes. And it strikes me in these calls to go overweight equities once again, and particularly US equities, and go neutral on gold, that you're almost saying that what has worked so far in the last year or two, it's time to reorient yourself.
Yeah, I think there's nothing wrong with taking profits. And what we have obviously seen is some of the calls we made early in the year have worked out really well. So for instance, we were overweight equities heading into the year, gradually taking some profits along the way. We even went underweight around April. And now, good timing. It worked out well, though we did have a good bounce back in the end of April. And then just recently, we've gone to an overweight positioning back on the equity side, and also into the U.S. equity side. Whereas on gold, we've had that for a couple of years. We've owned it for different things.
You mean you've been bullish on gold for a couple
of years? And in that environment, we've held it for, again, different reasons. So one was obviously the fact that we were looking for a good hedge, and fixed income didn't really do that in 2022. Then we were looking at it from the fact that sovereign wealth firms were buying more of it. And then, of course, we were seeing a lot of consumers, retail, buying more gold as well. So there's many reasons to own gold. And not all of it were working at the same time, but enough of it was working in any one of those areas to make gold drive much higher. And then more recently, obviously with Trump coming on board, the uncertainty factor was a big hedge for us for having gold in play.
So let's unpack this call a little bit, particularly the fact that you're going overweight U.S. equities, because this is coming at a time where international stocks have done so much better and people are wondering, is it time for U.S. exceptionalism to end and international to kind of resurge here?
Yeah, so if I take a step back, at the beginning of the year, or actually the last couple of years in particular, we've seen U.S. markets do exceptionally well. And so people don't tend to move away from what's worked really well unless they have a catalyst to do that. That catalyst really was Trump taking office and particularly the emphasis on tariffs. As that happened, people started to move to international markets, even to the US, even some money flew into China as well. Now, what we believe in the last kind of 6 weeks or so is that things have changed dramatically. For instance, a lot of the big risks are probably a little bit behind us. For instance, if you think about the tariff situation, we're not talking 60, 75% tariffs anymore. We're talking 10% with some selective, 20, 30% on certain regions along the way. So that means that that tariff risk is minimized, not zero, but minimized. And then when you look ahead, you've got some potential deregulation, the tax cuts coming through. The market's confidence levels is also not so bad. And what people were expecting was a significant drop off in the US economy, just hasn't happened. So for us, it means go back to what we were believing earlier, which is that the best companies, the best earnings, the best momentum still resides in the US. And there should be a bit of a catch up now between the US and Europe heading into the end of the year.
Except valuations are back up. The S&P 500 looks expensive again, especially compared to those international markets.
Very fair comment. There's no doubt about it. The US is still more expensive than international markets, but it also has the best earnings. It also has the strongest growth. So for us, we don't mind paying up a little bit in those environments where we think, especially in this environment, that earnings are really, really going to matter. And that's what the European companies haven't done as well. It's on the earnings front.
There's a lot of drama around the Fed too, and cutting interest rates. Can you just kind of put some noise canceling headphones around that and just understand that rates are directionally going lower? When might be an open-ended question, but we're moving to a period of slightly lower interest rates.
Might have to steal that headphone comment from you because that's a good one. People are so focused on the Fed. I think you're right. The key is to think about it over the next few years. Are rates going lower? And the answer to us is absolutely yes. But the key here is going to be just timing of when the Fed gets some more positive sentiment that inflation is not going to be soaring through, and that the economy at the same time is holding up well, which it is. So it's got no rush to cut rates. However, as time progresses and they see that inflation is not actually moving up tremendously, that gives them the indication to start cutting rates. They don't have to go aggressive, but they can start the process. So we do think we're going to see rate cuts in the US. The question is, how many are we going to see this year? I think we're leaning between 1 and 2, but probably continuation of that into 2026.
So the question is, what does this mean for Canada? We've had a nice little moment of outperformance. More than that, the index is sitting at record highs, despite we are potentially net losers from this tariff war. Our economy is not doing as well, but we know, and listeners of the show will know, that economy in Canada does not equal equity because the TSX is structured on something totally different.
Yeah. So we're actually neutral on Canada after being quite bearish over it over the last few years. And that's with us still saying that the Canadian economy is weakening. We're seeing high unemployment numbers coming through. Yes, we're getting hit by the tariffs as well. However, on the tariff front, we're still probably better off than our competitors out there. So that puts us at a competitive advantage against them. Secondly, the way things are heading, we should see the Bank of Canada moving a little faster than the Fed. So that should help a little bit on that front. This is why I don't think the US dollar significantly underperforms, because Canada will cut rates a little bit faster than the US, give that a little bit momentum there. But that will also give Canadians a bit of a competitive advantage as well in the short term. And then lastly, when I look around money flowing, we are seeing some sentiment coming back to Canada, which again is positive as well.
So you were bearish Canadian markets. And so by going to neutral, that's actually incrementally more positive than you were.
That's exactly right. So the last few years, we've been really tilted heavily towards the U.S. And underweight Canada on that front. We slowly been increasing our Canadian exposure. And the reason is because early on, the expectation was a much higher tariff number. We didn't think we were going to be at 25%. We thought it'd be closer to 10, which is where we're at. We got some more certainty, obviously, on the political front. And up to the last week or so, there was calmness on the Canadian landscape when it comes to Canada and the U.S. front. And I think we're back to a bit more calmness again today.
Yeah, Canada scrapping the digital services tax pretty quickly, less than 72 hours after Trump said that that's what he wants to be done.
I think we're all expecting that. I think, we were talking about the tackle comment with the U.S. I think every country's in the tackle comment. They all chicken out in the end when they realize the U.S. is going to flex their muscles.
Yeah, taco, that Trump always chickens out trade, which honestly has been working. I know Trump doesn't like to be called that, but, it really has just been equities all in. And I wonder if you think, I'm sure you get this question a lot, is there anything that can just overcome FOMO? Like, this is a market that you just can't take down. We were throwing so much at it into April. And yeah, we pulled back, but we still didn't even go into a bear market, right? The S&P 500 stopped right at that level. I don't know if you believe in technicals or not, but that is significant.
Yeah, we definitely look at technicals and fundamentals. What I would say here is that coming into all of this before Trump even took office, the economy in the U.S. particularly was very, very strong. It's not going to remain very, very strong, but it still remains strong on that front. So when we think back again to the fundamentals, that should still mean the markets go higher from here. Yes, not the same magnitude that we've seen over the last couple of years. Then you throw in the fact that we're probably going to get some tax cuts here. Deregulation is going to be, popular along the way, and we're not going to end up at the high tariff numbers that we were seeing. And if we end up with something like 10%, still very much manageable along the way. The question is, will the consumer continue to spend? The U.S. consumer has been very resilient up to now. Don't see why they will change that on that front. And then if you think through on the underlying data that we're seeing, yes, there's softening economic data again, but not dramatically a difference coming through. And we've been calling, and not us, but the broader investment community has been calling the demise of the consumer for the last 3 years. It just hasn't happened. So until we actually see that, we're not fighting the U.S. consumer. We're not fighting the momentum at the moment. But I will say, I do think there's a lot of still risks out there that people have not counted on, including geopolitical risks.
That's interesting you mentioned geopolitics. I wonder if that's something that we can just always ignore. And I say that because, let's talk oil, right? That's the one where we're going to see the biggest spike. We see a geopolitical spike, and then it just goes back down, And I wonder if it's such a hard thing to price in. It's hard thing to predict, which is why we see shocks. But for a long-term investor, is that something you can just ignore?
The interesting thing is I do agree with you on that. We don't change our equity bond allocations, as an example, if we see some geopolitical risk out there, unless we think it's really going to change underlying fundamentals of an asset class or a sector. And generally, we don't think that's going to be happening. So therefore, instead of taking our equity weights down when we see that happening, we just put some hedges in our portfolio, whether that's options or gold, to help protect against that short-term potential spike that we might see. Oil is a great example. We saw it spike up to the mid-70s, all the way back down to the 60s again, right? Now, I do think oil was undervalued before, but I don't think 75 is the right number given the supply-demand differentials that we're seeing. And we could still see this go even higher up still if we get more tensions building out of there. But that's not, to us, an area that you want to change long-term fundamentals. You might be able to do short-term trades, but you really have to be careful there because it can really move very quickly.
I've been noodling on where could we be wrong and what's something no one's really talking about. And I wonder if it's this idea that actually a little bit of inflation is good for companies. It allows them to raise their prices because often, they can control their costs, or they try to control their costs so their margins are big. And now that inflation is kind of cooling, and I take your comments about this, the consumer being resilient. But then I look at some earnings like from General Mills, from Nike, from Target. These are not companies that feel like they can raise their prices. It's not like coming out of the pandemic where everybody feels like they can raise their prices. And so we might not see that show up in inflation, but isn't that going to hurt profit margins?
It's a great point. I think on the inflation side, it really does depend on the brand power, if they can pass that inflation off to the consumer or not. If the consumer is weakening, it's harder to do that for sure. However, if I go back to the tariff situation, think about this. Let's say it's a 10% tariff that gets imposed. Now that's 10% on the goods that are crossing the border. And most consumers think my prices are going to go up by 10%. But the truth is only 40% of that actual cost of that product is coming from that raw goods. So really 10% on 40%, on the 40% is only a 4% tariff. Now, companies know that people are expecting 10, so they might do 7 and say, listen, we're doing you a favor. We're not doing 10, we're doing 7, but they've gouged up their profits by another 3%.
Oh my God,
and then
Sadiq!
And then you've got those consumers, the companies that actually are not impacted by tariffs. But again, they know that 10% number. They can either stay at 0% increase and try to get market share, go to 5, which is still lower than the 7 or 8 people might be doing, gain market share and increase profits as well. I'm not saying people are going to do that,
Diabolical.
but that has been historically how people think about things. And therefore, you do get some additional inflation that shouldn't have happened, but you also get increased profit margins.
That's wild. I didn't think about it like that. Okay, so that kills sort of my argument there. I'm curious, when you take this idea on the road, because your job is to meet with investors, what is the biggest pushback that you get? I just want to clarify, the reason I'm asking that is it just seems like, I read a bunch of strategists and I kind of know the vibes out there. And I feel like this is not a well-liked rally, that a lot of people resist it. They throw up arguments. And I'm wondering if you see and feel that in your meetings.
Yeah, there's no doubt about it. People talk about the debt levels in the U.S. They talk about, the Trump uncertainty for sure that's out there. And they all think about the consumer, declining. Those are the 3 things that we keep hearing constantly. There's even a 4th, but it's not tied to the markets, the U.S., losing its reserve currency. So when I look at all those 3 things, sure, the Trump uncertainty is the biggest one. We don't know what next month's big focus is going to be. So I think you always have to put a little premium that there's a risk going to be on that side of it. But I do think the tariff part of that has been a much lower risk now than it was at the beginning of the year. In terms of the fact that, we've had a great rally and time to slow down, that goes back to underlying data. The data doesn't support that we're having a poor economy. It does say we're slowing down. But I think when we get to the point where it's slow, that's when you want to revert and move around. And again, it's all relative. US, even with a slowing down economy, is still much better than Europe or Canada or emerging markets.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Let's talk about that gold call, because what a home run being overweight gold has been for the last 2 years. And you mentioned all the reasons that you were bullish on gold and how they changed over the last 2 years. Some of it was defense, some of it was just central bank buying and sovereign wealth buying. And obviously it hit all these successive highs in 2025. And that seems to be flattening out a little bit. So tell me why you're neutral from here on out.
Yeah. So at BMO Global Asset Management, the key for us right now is, what do we think we need to do to protect the portfolios in a uncertain environment? So that means pare down some of the bets, bring it down to a bit more on the neutral side. Gold has done everything we expected to do and then some. The uncertainty on tariffs are now behind us a little bit, as I mentioned earlier. The fact that the US dollar has weakened already. The question is, how much more is it going to weaken? We think a little less than what people are perceiving it to be. So again, gold has a little less for that on that perspective. And the third part is that we have seen central buyers buy gold. That momentum is still there, but maybe a little less than it was about 6 months ago. So when I put those things together, the reason to be as bullish about gold is not there anymore. Now, if we thought the risks were increasing again dramatically, we'd probably be buyers of gold. And if we have a pullback in gold, we'll buy. And I'll give you two examples of that. We did that when the election was done because people were uncertain about that. When Trump came on, they were all bullish. Gold dropped off. We actually bought more gold. And then again, when the tariff situation started to get a little bit more clear, gold came off again. We bought some more of that, rallied into it now. And now we're at the stage where we're feeling a lot more better about where things are at. Because we went +1 on our equities, which means we're overweight equities, we now feel that we don't need to have the hedge part on gold. We'll rather use it through options.
Perma bulls on gold will always talk about debt and the rising U.S. debt. And we've got, a potential catalyst in understanding the fiscal situation in the U.S. if they're able to successfully pass their reconciliation bill. And the question, of course, is how large is the deficit? And I feel like this is the year maybe all of this finally comes to a head. Everybody's been talking about the debt, watching that debt clock or whatever it is they do. How do you insulate for the risk around that? Like, forget about taking a view, but is that why gold should remain in your portfolio? Should you do that elsewhere? Like, how do you insulate for the risk of the U.S. debt problem?
Yeah, and we're not a perennial gold bull, by the way. So we put that in about 2 years ago, and we still have it. So it's neutral. And you're exactly right. It's for the what if scenario. And there is a lot of debt, and there's discrepancy as to how much the debt will actually be because of tax, the tariff situation, and any potential revenue growth you get from a growing economy versus not doing any of the stimulus that you're seeing across the board. I think when you look at that part of it, that's the question mark that still remains uncertain. There's no doubt that we're going to see a higher amount of debt, but we've been seeing higher amount of debts over the last decade. And the interest rate component of that is the biggest part of that debt.
And that could be coming down.
That's exactly right. So if we see rates come down, then potentially the cost of burden on that debt comes down with it as well, but not probably as much as people were expecting. So you have to take all that into consideration, but it is a risk nonetheless.
So how does this show up in the bond market? I remember at the beginning of the year and a little bit in the spring, this is where the bond vigilantes, they come out to play, and they, at what point are bond investors going to say this is enough, right? And force the U.S. government's hand. And it seemed like they did earlier this year. If interest rates go too high, that's something that even Donald Trump, mighty as he is, can't really fight against. But then yields just went right back down. They cooled way off. I'm looking at a U.S. 10-year around like 4.2%.
Yeah. At this moment in time, the equity market and bond market are acting in the same way. But you're right. Earlier in the year, even when we were talking about the tax cuts, we saw the bond market not react as positively. And everybody was expecting the equity market to do really, really well. And it actually didn't do a whole lot either. So people were worried about this debt bill that's coming through and how they're reacting to it. But as time has progressed now, what you've seen is people trying to feel a little bit more optimistic about all of this. Bond yields have come back down. You're seeing the equity markets continue to rally. So overall, everybody's keeping the bullish view on. And that, again, is going to drive these markets higher. And it's a sentiment and momentum. And you alluded earlier, this is probably the least invested bull market that we've seen because there's still money sitting on the sidelines. And it's coming in slowly, which it will also help fuel the markets. And we're heading into kind of the summer months where traditionally you're not seeing a lot of volatility coming in through. But I think, again, there's these positives down the road that potentially could drive markets higher, whether it's Fed cuts, a little bit more certainty on the tariff side, or again, the deregulation and tax cuts.
We haven't even talked about AI, which is that's just like a whole structural layer on top, right? It's kind of, obviously there's hype around it and excitement, but I think it's just like geopolitics in some way where you can attach dollars to NVIDIA. That's really easy to see, or like Meta and Microsoft and all of that. It's a less clear right now, how's a railway going to benefit? How is an airline or something like that going to benefit? But mentally, it seems like they will, because it's just an efficiency driver. And I wonder, do you just think about that in theory right now at your investment committee, or are you can you put that into practice, like the efficiency from AI?
Yeah, I mean, we're fortunate we have an AI guru on our team and a few other data analysts, data scientists on our team. And so we look through some of this stuff and think about it very carefully. I think the key here is that, AI is just actually still at the beginning. And so, yes, you see it prevalent in tech companies, but it is filtering to all the sectors that you see. And they're going to utilize it more and more effectively going forward, especially areas I think that you would call them as not very efficient sectors. Those are going to really benefit strongly off that. Will it mean that you'll see some, employment losses? Probably, but you might also see higher paying jobs tied to that as well. So you have to wash that out a little bit. But overall, it should make companies, again, more efficient, which means, less expenses over the long term, faster to do things. Again, their cycles will be improving a lot faster as well. And then people will pay up for that, right? Today, I don't think anybody's not heard of ChatGPT as a good example. People know NVIDIA. Yes, they lost a little bit of faith in it early in the year, but they're now being proven wrong. So that cycle is still going to be there. Is it going to be driven by the US or China? The answer is yes to both. And more people that get involved in it will help drive the earnings higher up over time. The problem is you have to look ahead a little bit. And this is like the internet boom that we saw way back when, where we had a lot of movement in internet stocks. Then we had the crash. And now look at them today. All those companies are massively, giants in the industry. I don't think that we're going to go through that sort of similar cycle when it comes to AI. I think it'll be a much shorter cycle to see that result. But it is still where people are looking ahead to say, this is going to be a really big thing, whether it's going to be 3 years from now or 5 years from now. Mm-hmm. But it's going to be really important across the board.
Salesforce CEO Mark Benioff, I just saw an interview with him, and he said this is the last generation of CEOs that are going to be managing people-only workforce. And going forward, you're going to be managing a workforce of humans and then a workforce of AI.
Yeah.
Are you using it a bunch?
So we use AI for sure within our processes. We use that to get information to flow along the way and optimize our portfolios. We're going to continue to evolve and use more of that over time. But right now, still, we do a lot of proper research that we do. I think that part is still important. The feel of where the markets are at. You still use technical analysis, sure, but it's the fundamental side that I think is important. When you talk to a CEO, it's what you feel and hear from them outside of the actual words itself that give you the confidence as well too. So it's important for us to still have those sort of meetings along the way. But I do think it'll make us faster to decipher data. I think it'll be more to be able to look at how does that impact multiple sectors when you hear one company say something, and even domestically and geographically around the world, how all that interconnects a bit more, especially as we start to move away from globalization a little bit. You might see pockets of things that you wouldn't have otherwise connected, but AI might help you connect that a little bit faster as well.
Yeah, but importantly, AI is using data that is online, right? And if it's not online data, like how is AI going to read it? We just had a guest on, John Ewing, who said, one of the things he looks for when he does these like shop floor visits is like, how is the CEO interacting with the employees? And I said, well, why does that matter if you're investing? He said, well, if the margins are low and you're wondering why are the margins are low, and the CEOs walk the shop floor and it's clear that he's never done that before or doesn't do that often, it's like, there it is, right? Here's somebody who maybe doesn't know how the business is run. So I wonder if there's going to be even more premium on that stuff that takes place offline that AI can't read.
Yeah, I think so that, those that AI can't replace, for instance, will be at a premium for sure. Those that can work with AI will also be at a premium as well. And then there'll be things where AI is already working with that are replacing other people that won't be at a premium anymore. So I think you'll see a different change, a different scope of what you're going to see out there in terms of the employment workforce going forward. Even think about coders. Coders were in high premium, and now people talking to AI can replace coders too.
I know you sent your kids to engineering school. Like, how are they feeling about this?
Well, the good news, I think engineering is broad-based, and it should be okay on that front. But that's exactly right. You have to adjust and figure out where we're going to be 5-10 years from now. And AI is still in the infancy that I don't think you can fully anticipate exactly where that's going to be, but it definitely is going to change the dynamics across the board.
And that was like so trailblazing, right? Teaching kids to code. And now all of a sudden it's like, oh, you don't need to do that. You just need to know how to prompt. Sadiq, we're going to take a quick break and we're going to find out your high conviction sectors. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so we know that Sadiq is overweight equities, likes the U.S. in particular, and is neutral on gold. But the U.S., there's a lot of different areas that you could go in the market. And the first area that you like is financials, not tech, financials. Tell me about why.
Yeah, so financials is something that when we look through, we again tie apart to the consumer. We think the consumer is relatively fine. Second, we think from a valuation perspective, doesn't have the high multiples that you see in technology, for instance. And then three, when you look at the yield on financials, it's still relatively good. And in an environment where we don't think we're going to see 20% plus returns, you want to have a dividend yield that makes up a big part of your total return. And so that gives it that element as well. And then lastly, I'll just say that when we think about how the economies are moving, we think financials are going to benefit off that a lot more, and more so than they did over the last few years. So there's a bit of a catch up there on the financial side. They've got some momentum heading towards the right direction. And then I think the underlying fundamentals of the economy will actually be beneficial for the U.S. financials in particular. I will also add, we also like international financials there as well. And I think that's an undervalued part, including emerging markets. And
actually, those European banks have, I feel like people may not realize that, but they've done better in some instances than even the Mag 7. So there's something there about financials that maybe fly a little bit under the radar.
Yeah, so on your point of international, if you remember SVB and the situation that happened, obviously there took down,
this is Silicon Valley Bank,
that's right,
which collapsed because it basically was doing no risk.
That's exactly right.
Yeah.
And that took down the whole sector, but not only in the US, but internationally as well. So you've got these international companies that are not at all impacted by this, getting hit quite hard. And then you have the US sentiment that's going on. So again, they're undervalued, underappreciated. And then they've come back really, really strong on their multiples, good valuations, good yields. And so they've done exceptionally well. So obviously defense has done really, really well, but this is another sector that's done well within the international markets.
Except we hear often, higher interest rates are good for the banks because they have higher spread, and we're moving in an environment where like the ECB and the Fed and Bank of Canada are looking to cut rates. So why isn't that a problem for financials?
I think you're right. On the interest rate margin side, you have some pressure there, but you should see more demand for credit as consumers have tied up on a lot of their spending excess savings. So you see a bit more of that. We should see, as rates come down, a potential bounce back in the housing market, which will help fuel the mortgage side. And for those banks that actually have their trading practices as well too, we should see relatively good trading practice that we're seeing, the last 6 months in particular, but that should continue on as well. So a really well diversified potential financial company should actually do really well in this environment.
So the thing that was remarkable about the rally from the April lows is that we went right back to those tech stocks and they really led the way. And you think that that's going to continue? That's your other top sector idea is to remain overweight tech, or is that a newish call for you?
No, we increase our weight now to technology as we increase our U.S. allocation as well. And this is it, that sure, everybody wanted to move away from the Mag 7, and I'm going to say broader tech than just the Mag 7, but those are the best companies in the world. They're the best margins that you see out there. And when you're talking about inflation and price pressures, they can pass off onto the consumer. If Apple decided to increase their iPhone price by $100, no one's going to blink. So if you think through some of that stuff, these are things that people use every single day now. So it's no longer a discretionary spend. It's more of a staple spend. And so we see this continuing to move higher going forward. Like most things, when the momentum stops, people move away. But when it starts to pick up speed again, everybody jumps back in. And I think when you get to the earnings side, you see how the earnings look really, really strong, people will continue to put their money back into the technology sector. Again, it's not a short-term play. This is a multi-year, multi-potential decade story of improvements across the board tied to AI, cloud computing, automation, all of that.
I feel like everybody tries to be a hero about tech. Everybody wants to be the person who says it's just like the bubble and catch that right call. But like maybe the more boring call is just to say, yeah, what you said, these are good companies and they'll probably continue to do well, so you should own them. And I feel like it's not as splashy of a headline, But maybe that's how you make the money.
Yeah, I mean, if you go back at the beginning of the year and then you think about where you were at, just before April, what changed technology that would cause you to lose your faith in them? I don't see much else. If anything,
some cheaper alternatives like DeepSeek, that was a big issue.
Sure, I agree with that. And if you thought that was going to change NVIDIA's, competitive advantage, for instance, sure. But it didn't really do much with that. The earnings were still very strong.
NVIDIA's back at an all-time high.
And so if anything, you should have actually added to your position in April. And so I think that's the part that people, got their minds got changed too quickly on that side. And again, I think if you're a long-term investor, you're saying, what really changed, over the long term? Sure, some things might have happened a little bit in the short term, but not a lot has changed over the long term. Are they losing their competitive advantage? Are they not going to be the dominant player that they once were? We just didn't see that. So to us, great time to kind of reamp our technology exposure.
So very cyclical tilt, right? Or pro-cyclical. You like the financials, you like tech, and your third idea is to actually move a little bit more bearish on consumer staples. It's kind of that safety trade that you're saying, tuck it away.
Yeah, I think those names have become a little too expensive. I mean, up to the end of April, staples was one of the best performing areas. Communication services, technology were the ones that were lagging behind. I don't think the consumer is waking up as much as people think that we need to tilt more towards staples. We're not getting the cheaper valuations that people would normally associate with staples. You're seeing across the board still spending continuing on. So I don't think it's going to act as well as people think it's going to act. Now, if we thought we were heading to a recession and we were really worried about tariffs and all that, then maybe we would move to the staples. But don't forget the staples are not also immune to tariffs. A lot of them get their stuff from China, and that's the big target as well. So I think when you look through that, that's an area we want to be a little bit more cautious about heading into the second half of this year.
I know, I look at a Costco. Although a lot of people defend Costco's valuation, but it's like a 50 times earnings for a staples.
Yeah, you still are going to go to
54 times actually last count.
Walmart, Costco, you think about all these companies, right? Yes, they are still going to be where you're going to see, but they've also increased some of where they spend their money into some of the discretionary areas as well. And so they are going to get impacted a little bit, but they're trying to go up that brand level so that they still get the higher consumer buying goods, maybe a little price or point that's cheaper than what they would go to a regular store, for instance. So the momentum, I think, on the staple side is not as strong as it once was. And again, you're paying up a little bit too much for it.
Sadiq, thank you so much for joining me on the show.
Oh, thank you very much for having me.
Sadiq Adatia joining us from BMO Global Asset Management. Make sure you tune in to our next show. We've got Bob Thompson on the show, part of Raymond James, and he's going to be talking all things commodities. So get in your questions. You can email us at questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.